Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Thursday, the 7th of September, Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Welcome, everyone. We're going to go through our usual regular run through calendar, what we've had, what we've got coming up, articles from the major news wires. What are those macroeconomic data, central bank fundamental events that are driving financial markets right here, right now? And then also take a look at the charts. What are the trigger points going in today on the major markets that you guys are trading? Okay, let's take a look first of all at the calendar. Look back first of all. I mean, to be quite frank, there's not a huge amount to focus on here. The market yesterday, we did have the global PMI data from S&P Global, the S&P Global PMI data, and then also the ISM data in here. So the ISM data actually beating expectations. The market took that negatively though. Stronger economy, good data equals bad, as in potential for a more hawkish Fed. So good data, bad reaction in here from this ISM data from yesterday. Bank of Canada left rates unchanged as anticipated in here. Overnight, we've had Chinese data in here, which was actually exports and import data better than expected in here. So that was a small positive. But yesterday, we certainly see the reaction to this ISM data. Good news equals bad, potentially for a more hawkish Fed selling off this morning's data in here. Slightly positive or overnight data from China. If we go forward into today now, European data in here has been fairly light, but we have had Halifax House Price Index from the UK. The housing market, very important to the UK economy. House prices falling significantly and more than expected. Worst data, I think, since I've got the headline in a minute, 2009. We'll come to that as we go through the headlines. And then the powerhouse of Europe. Remember, we had that negative, I think it was factory order data from Germany yesterday, right? Now, industrial production data from Germany, the powerhouse of Europe in here, the manufacturing powerhouse, the industrial production data worse than expected as well. So data keeps coming in Europe, worse than expected, which is a real concern. And in the US, unfortunately, it's like bad data for Europe, bad for market. Good data for the US, bad for market, because it means potentially a more hawkish Fed. So you can't win in here at the moment. The market has definitely got its bear hat on. Good positive US data, the market reacts negatively, and bearish European data, and the market reacts relatively negatively. Going into today, it's fairly light. Actually, if we look in the employment data in here, worse than expected in Europe as well, showing the slowdown. Real concerns that we're going to go into recession. Now, we remember we've already dipped into recession in some parts of Europe, and concerns we're going to go into a deeper recession in Europe. If we look in here going into the day, it's fairly light on the US side. We get our regular energy data in here. That's at 11 o'clock Eastern time from EIA data in here. Let's make sure I've got the... GMT -4. Yeah, just checking I've got the right timings on this. So we got the they got that data this afternoon. We do get the initial jobless claims. They've got this as 3 bulls. This is not a headline piece of data for me at all. It rarely has a significant impact unless it's significantly out of line. It has to be really out of line for this jobless claims data to have any real impact. Harker. We get Harker at 10 a.m. Eastern. We've got that crude oil inventory is 11 a.m. And then going on, we've got some other, remember it's Fed, I think I've closed it, but Fed blackout kicks in on Saturday. So we only have today, tomorrow of Fed speakers. So maybe clinging on to what these Fed speakers are going to say. Harker at 10 a.m. If I go down, I just don't want to miss any of these in here. Williams and Bostic at 15:30 Eastern and 15:45 Eastern. Bowman at 16:55 Eastern. Logan at 19:05 Eastern. Okay, so a whole host of Fed speakers, speaking engagements coming through in here before the blackout. Okay, so maybe watching out for those are going to be probably the most significant events we have coming through going into today. 5 things to start your day. Let's see what Bloomberg have got to say. Still tariffs in here, not really significantly going to be impacting us. But Joe Biden aims to seize on the absence of Russia's Vladimir Putin and Chinese Xi Jinping at this week's G20. Nothing that we're really worried about. Concerns about weak Chinese credit in here. That's a little bit of a concern in here. And stocks were slightly down in here, following through on yesterday's losses in here. And Treasury yields moved slightly lower after the surge higher on Wednesday. Treasury yields are really, as I've been saying, I've been mentioning all this week since I've been back in here. Treasury yields are the dog that's wagging the tail of the indices at the moment. Okay, so you're watching the Treasury yields, watching the Treasury bond futures market. We've been pointing out the levels on those for you guys who are trading the stock indices to be watching. Let's run through a few of the other headlines. So the dollar continues to climb in here. Remember, higher yields in the US, stronger dollar. Dollar seen as a safe haven whilst we're in this current risk-off scenario. Apple shares sink. Okay, I don't think it was anything particular on Apple. I don't think so, but I think just generally tech stocks down in here. I didn't see anything particular on Apple. I think it's just tech down because yields are up. Remember, growth stocks do worse in a higher yield environment, okay, as they because of the discounted cash flow. So growth stocks do worse in a higher yield environment. Many of the big tech stocks and Nasdaq stocks are growth stocks, okay, so their discounted cash flows gets more significantly impacted by higher yields. So with Apple Inc. and Nvidia losing about 2% in pre-market. Yeah, nothing in. Oh yeah, China's plans to ban iPhones. Oh, okay, in some government agencies. Okay, that was maybe the Apple news that I missed. Okay, in there. Okay, what else do we have in here? Emerging currencies. Now, remember, emerging currencies very much a risk asset, okay, a riskier asset to own. And emerging currency gauge is only up 0.3 this year after losses now. So the dollar did lose significant ground earlier this year. The dollar's made that all back and more. So the emerging currency gains from earlier this year is all but erased now because of the current risk-off scenario that we're seeing with the dollar strengthening here. This is twofold. It's one, concerns about a more hawkish Fed, okay, because the US continues to do well. You've got this kind of two-tier world now, and I think this is really important. We've been focusing on this. I've been mentioning this a couple of times this week, okay. We're seeing a definite fears of stagflation. Lower inflationary pressures still in place, and potentially slowdowns in the global economy. Europe, Asia, particularly China. Okay, so we're seeing that come through. But the US economy seems fairly resilient. The data in the US nowhere near as negative as we're seeing in Europe and China. And because of that, you've almost got this two-tier. And because of this two-tier, there's fears that the US could if the US economy data stays relatively strong, the Fed could hike again, and that keeps the dollar as king. Okay. For two reasons. One, because the interest rate differential, we could be seeing further cuts, deeper cuts in the US, but unlikely to see those deeper cuts. But a potential. Sorry, I'll start that again. We're unlikely to see more aggressive rate hikes in the rest of the world, particularly in Europe. Yeah, we're probably coming to the end because it looks like we're going into into potentially deflationary pressures, or not so much deflation, recessionary pressures coming through in Europe. So the pace of rate hikes is likely to slow in the rest of the world compared to the US. Okay, that's what I'm trying to say. The pace of rate hikes potentially going to slow because the US economy outperforming. On top of that, the US dollar is also strong in here because of its seen as the safe haven currency. So if the global economy is going to slow, where do you want your money? Well, certainly not in emerging markets, certainly not in the commodity currencies, the Australian dollar, the New Zealand dollar, the Canadian dollar. So you go to where to see the safe havens. Now, safe havens traditionally the yen and the Swiss franc in here, but at the moment the dollar is king. Why is the dollar king? Because they are more likely, the Fed are more likely to stay on a more aggressive rate hiking path if we get continued strength in the US economy and if inflation continues to hang around for the US. Okay. Right, what else have I got for you? China export slump eases. So this is the data I was speaking about. Exports fall 8.8% in August, better than July's numbers. This was the data here from yesterday that we just focused on. Yesterday's Chinese data in here. This data in here, here's your 8.8%. So Chinese trade data better than expected overnight. So a slight positive positive there. Oil's rally takes a breather, so oil has dipped slightly, not really a huge amount in here. WTI's 9-day rally pushed prices into overbought territory. API reports US crude inventories dropped by 5.5 million barrels in here. So watching out for the EIA data today. OPEC Plus also extended its supply cuts to the end of this year. So all of that has seen oil continue to push higher, but it has just paused in that rally. If anything, dipped very slightly in here, which is kind of slightly positive for stocks in here because obviously higher oil prices potentially inflationary. Transatlantic surprise gap opening up again. The US dollar is building another head of steam as doubts linger about whether the Federal Reserve is done tightening yet, even as the rest of those major central banks hesitate or ease off. This is exactly what I've been talking about in here. Red hot US service sector growth accelerated through August. This was that strong PMI data. As we see, look, again, you look, struggling Europe and China on the other has started to widen. So we're seeing that disparity, this two-tier world at the moment. The US is okay. The rest of the economy, the global economy, not looking so good. Europe and Asia, particularly China in Asia. Okay, well, obviously China, you would argue the powerhouse of Asia, the largest economy in Asia, second largest economy in the world. So all of this is adding up to this two-tier, and this is the thing we've been talking about. I've been talking about since I've been back, alongside those higher US Treasury yields. Wall Street slides as economic data asserts inflation and interest rate wise. So again, that PMI data in here, positive data for the US taken as negative. The Institute of Supply Management said on Wednesday it's non-management work. So there we go. There's the ISM data. Look, so losses leading the cards of stronger than expected service data fueled concerns that sticky inflation will mean that interest rates may stay higher for longer. So in here, this is where we let it off with, right? Positive data for the US seen as negative, okay, for stocks, and negative data for Europe seen as negative for stocks, okay? So you can't win at the moment, okay? We're definitely in a more negative theme. China's traced up narrow, so that's a positive. That was a small positive. And then here's that UK house price data. UK house prices fall by most since 2009 as rate rises bite. So that's obviously showing a negative for the UK economy in here. And here's that yield chart. So we have had a little bit of a pause in the upward pressure on yields in here overnight, but we went higher in yields. We took out, remember, we flagged in near the 428.29 level. We pipped above that, hit 430.31 in here overnight. We have dipped slightly lower in yields, but still the threat of still high yields. This is the next kind of line in the sand, 431.5, and then up to 436.5 up here. The high yield in here from back in late August. Those are the real concern. If we go and take a look at that, what that looks like on the charts, I'm going to start with the yield chart. I think it is important to continue to focus on this. You see in here, we went right down yesterday to this little yield low in here. Sorry, price low. Okay, on the price chart, it's 109.18.5. Yesterday, we got down to 109.19.5 on the US 10-year note. If we break there, that will be a real concern, okay? And then open up the actual low, which is down at 109.09.5. So watching out for that, these levels if you are trading even if you're trading the stock indices. I'm still looking for no change at the next meeting, but if we look into the end of the year now, chances of a rate cut are fading. If anything now, look, this is where we are now. There's the, sorry, not rate cut. We're still looking for the hike in here, potential hike either in November. So here we are, now we've got getting close to a 50-50 chance for November, okay? 52% that we stay unchanged by November. And then we're, if you add these two together, in here with 48% in here chance that we are hiking rates in November, and then certainly looking for still the same kind of thing in here, 46% chance that we're higher at year end. And then now if we look out to March, okay, there's less chance that we're going to get a rate hike by March now. Look, so that's unchanged, okay? So we're looking for, we will get a rate cut, maybe one hike and then a cut, but our rate's going to be lower by March, not much of a chance. This is current rates in here. So there's only a, 25, 26, 27.5% chance that rates are lower than they are now by March. And if we go all the way out to May in here, there's current rates. Look, very little chance that we're going to be lower, than we are currently in here. Maybe the same as we are, or potentially higher come May. So higher for longer is the mantra that we're getting from the US. Just a quick look at where we are overnight. So despite that positive data on the trade data from China, the Hang Seng, the Hong Kong index in here down 1.34%, Nikkei down 0.75%. That was on the back of losses. Remember, playing catch up with the losses that the US suffered yesterday. European gauges, we do have a little bit of a respite in here in Europe. So we do have a 0.3 higher on the UK FTSE and the French CAC. The German DAX index fairly unchanged in here. And if we look at the overnights on the US, we are slightly lower in here. So S&P's down about 1/3% and 2/3%, still lower, having lost ground significantly yesterday, still lower for the NASDAQ. Let's look at the charts. We did say it's set up as here slightly more negative in here for the S&P. Let's say while I'm on this tab in here, just have a quick look in here. So gold was lower again today. It's hovering right above some notable support in here around 1940, 1938. Okay, and with dollar strength, gold continues to be have downward pressures. The dollar has had a little bit of a respite, but sitting just below recent multi-month highs. And you see the high with this swing high we have up here. So the dollar sitting right on this swing high up here and potentially looking to blast through there. So potential upside still coming for the dollar. If we do get further upside in the dollar, then the risk is then we get downside in here for gold, down from that 1940, 1938 level down towards here support at 1931. Oil in here, a little bit of a respite, having basically hit $88 in here yesterday, but not much of a respite. Still looking to be probably buying dips there on oil. And if we go and take a look at the stock indices, the ES and the NASDAQ, let's start with the ES in here. So down again yesterday, we were looking at this 13-period EMA. It broke the 13-period EMA down through there, and it did have a little bit of an intraday bounce yet overnight, but then down lower and sitting on the recent low. So the ES in here, I don't know why I've got this on a 5-minute chart. Let me switch this to say 30 minutes. I'm looking vulnerable through the recent low from yesterday, down there at yesterday's low 44.47, and potentially now targeting a move down towards 44.33 to 44.23, 33 and 23 potential downside targets on the ES. If we look at the NASDAQ again, it took out and just managed to rebound from the 13-period EMA. Did go below there yesterday, but through there this morning. Now there's we've got not a lot in here holding up the NASDAQ. Okay, so the NASDAQ could easily see a fall down here to like the low 15,000. So if we look here on the 30-minute chart, there's not a lot. You've got this big rally in here for the NASDAQ. There's not a lot in here holding the NASDAQ up all the way down to like 1550. Okay, so the NASDAQ could see a significant sell-off in here today, I do think. And if obviously NASDAQ goes, it's going to tug the S&P with it. So watching out on the NASDAQ, I think that's where the real vulnerability. We're already sitting right on yesterday, the overnight lows in here on the NASDAQ. Watching out for those yield charts, not only the yield and the price charts for the futures. If we break support on those bond markets in here, I do think we could see a significant sell-off driven lower by the NASDAQ in here. One other little level in here, you can see we've got this trend line that comes up here between these two lows in here. Okay, so that could, that's taking this all the way down to there, like 1550 anyway, right? So there's not much in there. The only other thing I would put on in here potentially is a Fibonacci retracement of the recent rebound rally in here. And then we're sitting right on the 38.2, okay? So through the 38.2s, which is around 255, would take us down, 255, 260 would take us down. 50% level in here is at 15,135. Okay, so that's the real risk in here. And then that impulse low there, which is down at like 15,050. So lines in the sand to watch out for: 15,250, and then we have 15,130. And then 15,050. And I think there's real potential significant downside for the NASDAQ in here today. All right, guys, any questions? No questions. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you with another Bull versus Bear webinar tomorrow to wrap us up on TGI Friday. Cheers, guys.